With the current state of global events, there are all kinds of information out there saying different things. While it is best to keep an open mind with the way things are going, it would also be helpful to find out what the professionals think. In this video, we will discuss the thoughts of investing experts and how we can best equip ourselves for the upcoming crash. Hello and welcome to Investors Facts, where we address all of your investments needs and questions. Stick around until the end of the video to learn more about investing and to be one step closer to that financial freedom you've always wanted. Do you recall the panic that swept over Wall Street in September 2008? Well, several signs suggest that it's happening once more. And according to the market analysis, it will be extremely difficult to halt selling once it begins to spiral out of hand. The Dow Jones Industrial Average saw its seventh largest single-day loss in history on Monday, dropping to its lowest point since June 2020. The decline was greater than anything we saw in 2008. The monthly inflation report, which revealed that recent measures to slow the price increase are failing, fueled a rapid shift in investor mood, which indicates that additional rate hikes would be forthcoming. Major market participants are warning us that the stock market meltdown is about to get much worse and that we haven't reached the bottom yet. Right now, there is a lot of discontent on Wall Street. On Tuesday, there was yet another significant sell-off, and things are starting to look very scary. Yesterday, the Dow entered a rapid fall and the other indexes soon followed. The Dow dropped 1,276 points in a single day, losing 3.94%, and finished the day at 31,104.97. Even worse results were achieved by the S&P 500 and Nasdaq Composite, which fell 4.32% and 5.16% respectively. Only 5 equities finished in the black for the S&P 500's 11 sector, which all posted losses. The biggest losers were tech equities, with semiconductor giant Nvidia down 9.5% and Facebook parent company Meta falling 9.4%. Since the peak of health crisis, the day for stocks was marked by severe falls. Of course, one poor day doesn't equal a full-blown breakdown, but it could be a sign that one is about to happen. The similarities between the stock market's present activity and its conduct before the devastating 2008 meltdown are startling. One internet commenter who connected current stock market moves to those that came before the darkest days of the global financial crisis commented, "God help us all." Another graph provided by the research team Sentiment Trader demonstrates that institutional traders purchased put options worth $8.1 billion this week, which is 300% higher than they did in 2008. The acquisition of a put option grants the holder the right to sell a security at a certain period and is typically taken as a bearish view of the stock's future worth. Researchers said that the data is astounding. No chart has stood out as much in my 22 years of doing this. Concerns about inflation had a major role in the downfall. Stock values have been in an irrational hope cycle since the beginning of the year. They decline when inflation pressure persists, rise when investors think the Fed will lower rates, and then decline once again when new data is released. Since August's inflation numbers were so much worse than forecast, traders currently believe that a full percentage point will increase next week with a 1 in 5 possibilities. That would be a quadrupling of the typical change. And a day ago, no one in the futures market had predicted such an increase. Traders now estimate a better 60% possibility the Fed will raise its federal funds rate to a range of 4.25% to 4.50%, claims the CME Group. They estimated the likelihood of such a high incidence to be less than 17% a day earlier. Given that a poor inflation number was sufficient to provoke this kind of stampede, it won't take much to trigger a major exodus in such a perilous situation. The carnage may end up being far worse if a significant black swan event occurs. The chief executive of the biggest hedge fund in the world claims that investors' suffering has just begun. Greg Jensen, a co-chief investment officer of the Bridgewater Associates, stated during an interview at the Salt Hedge Fund conference in New York that the stock market hasn't fully priced in a recession just yet, and that the US is at the center of a global bubble that is ready to explode. The co-CIO pointed out that because investors underestimate how much the Fed is tightening policy, asset prices will continue to decline. The assumption that we will eventually revert to basic prices akin to the pre-COVID era is, in my opinion, the largest error at the moment. Jensen emphasized that his remarks confirmed earlier, once made by his fellow chief investment officer, Bob Prince, who told Bloomberg earlier this year that the United States is on the verge of a catastrophic stagflationary crisis, a toxic economic concoction of slow growth and high inflation that would have devastating consequences. Investors failed to promptly factor in the effects of a fresh slump in the economy. U.S. economist Aishi Amemiya of Nomura wrote in a research note on Tuesday that the markets continue to underappreciate just how entrenched U.S. inflation has become and the magnitude of the response that will likely to be required from the Fed to dislodge it. He claimed the central bank will be compelled to raise rates by 100 basis points at its next meeting to ensure the price stability. Now, however, other economists contend that the current climate is distinct from that of the early 1980s. And that the people who anticipate that raising interest rates will reduce inflation as they did then be sorely disappointed. They claim that these policies will only lead to an economic downturn akin to the 1980s and a collapse of the banking and property sectors. Yesterday, Bank of America stated that the bear market cannot be gone because prices are still too high, and stock prices are still too high, at least by one metric, which has a 100% success rate. A return to a bull market is still doubtful, according to the Bank of America economist Savita Subramanian in a letter to investors. As a way to predict the beginning of a new bull market, Subramanian and her colleagues monitored a lengthy variety of factors, including the Fed decreasing rates, growing unemployment, and the market gains of 5%. However, just 30% of those items have been completed thus far before demands leave the bottom of the list. Historically, 80% of the list is crossed off. S&P 500 companies would need to outperform profits estimate by an average of 50%, or in more extreme cases, the S&P would need to decline by more than 40%. To 2,500 points or inflation would need to reach 0%. They added, for signal stocks to be due for a bull market rally once more. We have a long way to go before we get there. Additionally, Morgan Stanley has more dismal news for the market's future. The Wall Street Journal predicted that despite of S&P's over 19% decline so far this year, it will go significantly farther over the coming days, weeks, months, and years. Our 22, 23, 24 base case predictions are currently 3%, 13%, 14% behind consensus, respectively, according to a group of analysis under the direction of Mike Wilson. Although we do not include an economic recession in the scenario, 2023 now represents a minor earning reduction, negative 3% year-over-year increase. Despite the subpar performance of stocks year-to-date, we do not believe that bear market is gone if our earnings projections are accurate. Similarly, renowned investor Mark Morbius concurs that markets still have further to fall. "No, we haven't yet reached the bottom," tweeted him. Following failures, search for the bottom. Failure of two SPAC ETFs is far from sufficient. The renowned investor is essentially suggesting that a new crash is already in progress. The losses from Tuesday pale in comparison to what comes after. These posts are consistent with Burry's typical pessimistic outlook for 2022. According to Bloomberg, Burry, the founder of Scion Asset Management, has made predictions about the impending instability on Twitter for much of this year. He believes that market nonsense and consumer spending will hurt investors. Based on the benchmark index lowest tick during the prior crashes, the experienced market players predict that the S&P 500 might fall another 53% to below 1,900 points. Similar to Burry, Robert Kiyosaki raised the alarm yesterday, stating that the crash is imminent and that what we call the biggest bubble in human history would burst in an equally historic meltdown. There will be a mass extinction. Furthermore, Jeremy Grantham, a seasoned investor and co-founder of GMO, reiterated his warning of an approaching burst in a research report published this week. Grantham previously warned about an enormous super bubble involving stocks, bonds, and housing. Grantham criticized the most recent stock market recovery as a fleeting respite and claimed that prior bubbles were invariably followed by market falls of at least 50%. The renowned strategist emphasized how a painful confluence of pressures, which points to dwindling corporate margins, food and energy crisis, pandemic disruptions, the Russia-Ukraine conflict, and longer-term issues like aging populations and labor shortages, spells trouble for asset prices and economic growth. Every historical parallel, he continued, suggests that the worst is yet to come. Each cycle is new and unique. However, he persisted in pointing out every example from history that indicates that things could get worse. The billionaire John Catsimatidis also issued a startling warning, claiming that rising interest rates will have more negative effects than positive ones and will finally tip the economy and financial markets over the edge, causing a new global financial crisis. Catsimatidis urged the Fed to halt monetary tightening in a Fox Business interview. Therefore, I contact the Federal Reserve. We will ruin the rest of the nation if we keep hiking interest rates. It needs to stop happening. Someone has to say so. They also intend to destroy the remainder of the nation. If a recession exists, it may develop into a depression, he added. Never had the future seemed so bleak. Investors are feeling the rise in risks. We urge you to prepare yourself for a devastating stock market meltdown because all available information points in that direction. Once again, this is Investor Facts, ensuring that all your questions are answered. If you enjoy watching the video, kindly leave a like and subscribe. Until the next time, cheers!